All right, everybody. This is the session on the Elliott waves. We did talk about it in the morning. The recording had a problem with the voice, so I'm just recording this once more again, just all by myself here. I'm going to talk about the key things that we talked in the morning so that you can refer back with the education material that we have in the channels, and we can talk through them when we are working on our charts on the weekly basis and on everyday basis when we are talking on the trading floor, right? So getting started, the way we covered today was to go over the basics of Elliott waves, the different categories of waves, the impulse and the correction, and the different types of correction, and look at some live examples and apply them to some of those charts that we trade on a daily basis, right? So, starting with the basics, the two types of waves that we have in Elliott waves is basically an impulse or a motive wave and a corrective wave. A motive wave is called a motive wave because it's supposed to move the stock and stock price in a direction. It's a directional move. The stock moves from a price X to 5X or 6X over the period of time. Whereas the corrective pattern is retracing some of that move by a smaller percentage. Not completely, but by a smaller percentage. Right? So impulse wave is there's just one kind of impulse waves. There are different variations on what can happen in wave 1 and 5, but impulse is just impulse wave, whereas in the corrective waves there are multiple patterns, and we'll go over that patterns today, right? So to begin with, let's start with impulse waves or motive waves. So the impulse wave is a five-wave structure where the wave one is formed when there's a new hype or new technology or a new news about a stock which is kind of gaining attention. It could be a new IPO launch, and the stock is just kicking off because of the hype that it has, right? So creates a wave one, which is like the primary wave up here, and then the goes down, like hype dives down. What happens? The stock nosedives to a certain extent, but what it doesn't do is break the bottom from where it started. So it'll stop somewhere in the golden zone ratio, and we'll talk about those Fibonacci retracements in a bit. Stock dives, different institutions, major buyers, big boys, they are all accumulating the stocks while everybody else is selling. And when the price kind of bottoms out in a golden zone or in the Fibonacci retracement that we're going to talk about, the next move starts. Again, it's not very immediate that it starts. Takes time to accumulate that stocks by the big buyers, and finally, when the company is actually meeting expectations, and we see revenue start to grow, or the hype is now making more sense, it's coming to reality. We see that okay, in future the stock is going to do well, and that's where now the price is being marked up, right? More and more buyers are coming, and institutional buyers kind of start buying in more shares and marking up the price, and that leads to this whole wave three up here, right? Followed by there is again a stagnation in price, which is another balance formation which happens because some of the investors wants to get out, some of them are looking for a lower prices. So all those market buys goes away, and there is a pause in the price, and they are waiting for a company to kind of keep delivering, put more quarter on quarter revenues and all that good stuff before they can kick in a next cycle, right? So we have certain dip in a formation which is not really bringing it price all the way down, but it's kind of just hanging it up here. And we'll talk about the retracement levels for these. And once that accumulation is done, the price marks is marked up again. And this is the last wave, called the fifth wave of the motive wave, where most of the institutional investors start exiting. They start emptying their inventory because they know that okay, the company has delivered. They want to wait for the next few months or years to understand, is company gonna keep going up, is this wave gonna extend, or is this gonna be just it. I mean, all whatever market value the stock would have gone to, it's gone to. Now it's time to get out, right? So this is where the wave five ends. Now, once the five waves ends and the company doesn't bring up any new value to the investor, that is where we see the price starts to drop. Could be an initial first fast drop. We could see a bounce, but then again, I mean, there is nothing new coming from the company, and there is nothing new being marketed, or we don't see any upsell sort of opportunities in the company, and that's where everybody starts to exit, and we start looking at deeper moves in that one, and that's called a corrective move to the first one, right? So company is back to wherever their book value was, or the innovation basically died down, and they're just another company on the block, right? So that's where we see some of that pullback coming in that stock. Now it can go all the way down and do something else, but if the company is strong, they are like continuously building up a pipeline, they are innovating, they are under the radar, right? They are doing something, right? This particular correction can take a lot of time, where every other person is just exiting because it keeps going down, and now if the company's basics and ground fundamentals are pretty strong, all the institutional investors are just looking to get in, and get in at the lower prices, the prices that they bought before, because they like that prices, right? That's where the next wave starts again, and it becomes a larger three on a bigger cycle, because the first one that you had was wave one. Now, does this happen to all the stocks? No, right? The first one could be just a hype, and then it dropped down, but the company never delivered, and this can just go deep down and break the first move, right? And keep going down, right? That can happen. It doesn't have to. It has basically, the move in the price has to match the fundamentals and the market expectations. It doesn't go along with whatever we are saying, that hey, if some stock has made a first impulse move and then it moved back to where the first top was, now it is time to go up. Now the fundamental of the company has to match, right? So that becomes very important, and of course there are validations that we do to these paths. Then when we make it, that it's matching to what we see or what we are hearing in the news, right? What is going on with the company, how their quarter on quarter earnings are coming up, and all that kind of good stuff. Right now, this was just a one impulse wave and a corrective wave. Now, let's talk about what happens within the impulse waves, right? And what kind of extensions do we see within these impulse waves, and what are the structures in within these impulse waves first, right? Before we go into the corrective move. Now, this was just a simple impulse wave at a larger degree, but when we start breaking down the structure of these impulse waves, these are called um, there are like sub waves into this, called the fractal structure, basically within the waves, right? So the wave one, which I let me mark these waves first here. Wave one, two, three, four, five, right? Wave one, five waves within that, right? And then wave three will have five waves within that itself. So wave one, three, and five, they all have five waves within it. Let me just draw them quickly here. Right, and like this. So wave one, wave three, wave five, all five waves in it. But the wave two and wave four, they will have three waves within it. I already marked the three waves here, right? So this overall impulse structure, looking at the substructure or fractal structure of these waves, this is called a 5-3-5 structure, right? Let me just mark it, because wave one was five waves, wave two was three waves, wave three is five waves, wave four is three waves, and the wave five is again five waves, right? So it's a 5-3-5-3-5 structure as such for an impulse waves. Now, when it comes to the retracement of the waves, right? So when it comes to the retracement, the before we even actually go into the retracement, let's talk about the basic rules, right? The rules that should not be breached when you're drawing the waves. So there are three rules to Elliott waves for an impulse move. The first rule is that wave two cannot go below the start of wave one, right? Basically, your wave two here, right here, cannot be like this, right? It has to stay above the starting of the wave one. Stay above this particular line, right? And the Fibonacci retracement, when we talk about it, is generally about 61 to 78%. That's what we call it as a general the golden pocket zone, basically. And 61 and 78 basically is a good place to go come here, right? So wave two cannot go below wave one. The second rule that should not be broken is that the wave three cannot be the shortest as compared to wave 1 and 5. So among the three fast moving directional waves here, which is wave 1, 3, and 5, the 3 cannot be shortest. The 3 has to be the longest one as compared to wave 1 and wave 5, right? Now, when it comes to wave 4, the wave 4 expected retracement is either 23%, 38%, or at the max 50%, right? 38% is a very sweet spot. We'll see most of the waves generally getting up to 38%. We can accept 50% as well, but the third main rule, which it should not break, is to enter into the territory of wave 1, which is basically doing this, right? It cannot work like that. That's the rule which should not be breached. So if this was the breakout point, it's gonna stay above that, and that becomes your third rule. Wave 4 cannot enter into wave 1. Right, so these are the rules that are very basic, should not be violated when you are marking something as an impulse wave. All right. Now, this was how it was first drafted and practiced by Mr. Elliott, and later on some modifications came to something which is more acceptable in certain cases, more exceptions basically, right? They and we see them on day-to-day basis, which was the leading diagonal and the ending diagonal, right? And all of this material is in the Elliott wave battle cards, right? With all the different permutations, combinations, the different things which are possible, the extensions, the retracement, and all the kind of stuff, right? And I'll talk about the extension as well. So I talked about the wave 2 and wave 4 retracement. Let me just quickly also get into the extensions of these wave 3s and wave 5s as well, right? Before I actually get into the leading and the ending diagonals, right? So those exceptions were made, and we'll talk about it and where are those particular exceptions can be used, right? Which is basically the leading and the ending diagonal. So let me quickly first talk about the extensions, and we'll get into that. So talking about the extensions for wave 3, so a very minimal expectation from a wave 3 is generally somewhere around 161% to 200%, right? 161% again is a very sweet spot. If you see it there, and if you have entered a long, basically here on a breakout, you need to book profit at 161%, right? This is a kind of a very sweet spot The wave may extend, may not extend, but it's a good place to take the profit, right? So 161% can be 200% and can be like 361%. Recently, in the case of SMCI, I see it going up to 461%. I mean, that was like very rare case. It doesn't happen like that. And generally, you'll be limiting somewhere around 161 to 261%. Anything beyond that are the rare cases, right? So that's your extension for wave 3. We talked about the wave 4 retracement. And when it comes to wave 5, a very simple rule that can be used for wave 5 is that wave 5 can be equal to the size of the wave 1. So you can just see how big your wave 1 was and just apply it here and say, hey, this is where your wave 5 is going to be, right? So that's one way of doing it. And there are extensions where wave 5 extends, and how to measure those extensions is that you take this extension tool. You start from the point where you started counting your wave 1, take it up to all the way to point 3, and put your third point at wave 4 bottom, right? And you look at the 0.61% and 100%, right? So if your wave 5 is going to be equal to wave 1, it'll be coming somewhere closer to this per 0.618 area. In this case, majorly the wave 3 is the extended wave, or the longest of all. Remember, it shouldn't be shortest of all three, but it couldn't be that it's in the middle, right? Either your wave 5 extended or wave 1 was extended, but wave 3 was not the shortest. It was bigger than at least one of the wave, while it was not the one which was extended, right? Only one wave can extend. It could be wave 1, it could be wave 3, it could be wave 5, but wave 3 cannot be shortest. So if your 5 is extended, your 3 will be still bigger than 1, right? Or any other alternate combinations. So that's another rule. So 0.618 in a very case of extension where things keep moving, this wave is quite extended, you'll see something like this as well, where wave 5 goes like way too far from where you counted 3 and 4. It's no more equal to wave 1 and keeps going and makes you think maybe it's like a very extended wave and keeps going, but no, it's just an extended wave 5, right? So this was all about an impulse wave. Now let's talk about the exceptions that we said, the leading and the ending diagonal. Where do they come into the play, and what are the rules associated with them, right? So as the application of the study was happening, folks started to seeing waves like this. Yeah, like this. Basically, a wedging based, a wedge sort of a wedge based structure, which happens mostly after a big sell-off, right? Like a stock was in a major drop down, it dropped, and we started seeing this wedge formation. Now, this wedge formation can be seen as a bear flag, where you expect that, hey, the price is going to break this and break down in the continuation before it bottoms out. But what happens? It kind of doesn't do that. Instead, it comes down here, does a false breakout, and moves away, right? Moves in a different opposite direction from where it came before, right? So this is where leading diagonal was introduced as an exception, where this wave 4 basically is overlapping with wave 1. If you see here, like I said, it's a rule. It should not be broken in a normal impulse. But here you see wave 4 is entering into the wave 1 territory, right? And so this was considered as another form of an impulse move, a wave, but it does not mean that this is possible now that this 4 can be coming into this. No, there's certain places where these leading diagonals are expected to happen or can be accepted if that happens, right? So I do not start the charting thinking that this kind of a wedge is going to lead into a good move in the upward direction or in the opposite direction from where the reversal from where the first move was, like this move down, and then it's quite an opposite move out here, right? Before I start assuming that, um, there are certain validations that need to be made, right? Which is where we don't see the cell creating new lows here, right? So if it does, it was simply a bear flag, right? But it halts somewhere here, and we get another break out of this wedge towards an opposite direction, to an upward direction, right? So that is where we start using this leading diagonal leading diagonal as a use case, and it happens mostly in the wave one. So basically wave one, where I mark this as a normal impulse, where wave four was not intersecting with wave one, right? Uh, this is allowed. Basically, if this would have happened, this is allowed with the leading diagonal being the first wave structure. It does not mean that it is allowed in wave three. Like if you have a wave structure like this is not this a leading diagonal or an ending diagonal. It cannot happen in wave three. That's a rule which we have to follow when using leading diagonals. Leading diagonals also get used in correction patterns. I'll talk about it, but it cannot be in wave three, right? Now, while we are talking about the leading diagonal, let's talk about the ending diagonal as well, which happens once this wave 3 is complete here. We get into this wave 4 drop, and then we get into something like this, where again, instead of it being an impulse, which I showed up here, you have a ending wedge, right? And you're able to mark it as a wedge. Again, the rules and the percentages and all that is in the battle card, so I want you to use them. We don't have to spend time on that one here, but the formation and the structure, right? So when this happens, you see a drop after that, right? And we can simply mark this as a complete 1, 2, 3, 4, 5 wave on a larger degree. It's just that it started with a leading diagonal, it ended with an ending diagonal, right? It's just showing you the use case of these leading diagonal and ending diagonal, right? These were added on later on and are well accepted, and we see them on the everyday basis, right? So this was all about an impulse or a motive wave. Now let's start talking about corrective waves, right? Correction. So now while we are here, let's talk about the first type of the correction, which is going to bring this whole impulse move back down, which we call it as a pullback, and we want to, buy when that pullback completes, because we expect, okay, this whole 5 waves is gonna lead into a pullback, and then maybe another move upwards after that. So either we are short here, and then we later on want to buy once it reaches the demand level, right? So the first kind of correction is called a zigzag correction. So where I told you that we have a 5-3-5-3-5 wave structure here. We have 5 waves here, 3 here, 5 in this one, 3 and 5. Zigzag wave is basically 5-3-5. So let me just tag these ones while we are at it. So this was 5-3-5-3-5, and this wave is basically a 5-3-5 as a zigzag correction. Why it's called 5-3-5? Because though it's a 3-wave move down instead of a 5-wave move up, retracing partially, it's labeled as ABC. But when we look internally on a fractal, we will see that it has 5 waves in the first one, 3 waves in the middle, and then 5 waves down again, right? So this is called a 5-3-5 structure, and the few basic principle of this wave corrective wave is that your wave B is generally somewhere from 50 to 60%, 61%, right? So it'll travel somewhere half the way, and then the drop will happen. And we also use a rule called A equals C, where when we check the extension of the C wave, it basically ends at 100% extension, so somewhere around there, right? So just marking it right. So 100% A equals to C, but the length of the both waves is equal, marked from the 60 or 50% wherever it starts to drop, and it's called a zigzag move down, right? So now, before I go into further correction modes, I wanted to share an example here, which is basically showing the we have discussed so far, right? So it'll help you understand the practical application of both these wave structures that we have discussed, right? So let's get into that. So right below, I have a PayPal weekly chart to just demonstrate the same concept that we discussed above, where we had, the first starting when it was launched, a leading diagonal. Basically, when the company was formed, things were coming to the market and the product was launched, and digital wallet may not be a very known thing to everybody, so everybody was evaluating what it is and all that kind of stuff. So not very spiked up move, being an innovative technology, but people still evaluating and slowly buying up, understanding the market and all that. So you see a four wave overlapping into one, but a very very good example of how the leading diag was formed. And then you had an explosion out of this after this small drop, like I explained in the above example. Instead of this being a bearish wedge dropping and crashing down, it actually went upwards and had this blasting move candle, leading to a new trend upwards. And the wedge is now broken with this candle, and taken the rest there, and then the stock just moved away, right? So good example of leading diagonal here. And then you have wave three, which extended up to 300%. Like I said, realistically, I mean, 161% is good, but if the stock is doing well, the news is keeping up, and they keep delivering, 261%, 361% is achievable, right? Wave three, and then we got a wave four drop here, marked as an ABC, and this is a flat structure. We'll talk about this one in a bit in the corrective patterns. But this was a wave four, and if you see, measured from the point where the two ended and where two ended and up to the three completion, it dipped up to 38%. And right from there, it was during the COVID time, and right from there we had the fifth wave starting. So now if you see, a fifth wave was quite extended as compared to when I was saying it could be equal to one, it could be 100% or 61%. It was certainly 100% when if I measure from the 1, 3, and 4 points, like I explained before. We can do it right here once more again. Yeah, it goes up to like almost 100%, right? So the fifth wave terminated, and then the correction started. Now, if you see, the correction itself is very impulsive down. So it was clearly counted as 1, 2, 3, 4, 5. And if you have a 1, 2, 3, 4, 5, it cannot be just alone, right? It's a one part of the correction. So it was an A leg, and then we had a bounce for a B wave here, and then we had a choppy wave down again. So We talked about leading diagonals being in the wave 1 and ending diagonals being in the wave 5. There is another rule to it, to remember that the leading diagonals can be in the wave A as well. While this was not a leading diagonal, it was a very clear impulse. It could have been like this, that the 4 overlapped with 1 and we had a very choppy drop B and then a choppy drop, but it was a impulse down. But it can happen that you get a choppy drop like this, where your first drop is like this. You have a B move, and then you get another choppy move down. So you can have like both leading and ending diagonal in a zigzag with 4 overlapping with 1, and it's possible, right? So we have seen this in the past as well, right? But this is a good example, a leading diagonal, an impulse down in opposite direction after this whole complete impulse happened, and right, and then ending within C leg within ending diag. And now we are waiting for what happened next. And a question was asked in the morning session that, hey, does this mean that now this is complete at exactly at 78% at a golden pocket? We are expecting something like this. So this is very speculative, right? So Elliott wave is not to say that, hey, if this completed and now it's at 78%, it means it's gonna be now another 10x move or 20x move from here on a larger degree. It can happen, right? But it totally depends on the fundamental of the company and the innovation of the company and the revenues and what market sees as a breakthrough product or something that they see value in and all that kind of stuff, right? Otherwise, this was just one complete impulse, could be marked as an A leg. If, let's say, PayPal is a business which is not going to do well and they're just going to be not innovative anymore, this may be an A leg, this may be a B leg with an ABC, and now we may be looking at something of C rather than a 3 where it goes up but not to at that much extent, or it may go sideways, right? So it may do another correction pattern here before anything else comes up and all that, right? So at any moment of time you have to keep evaluating your charts and making sure it's going in the direction the fundamental align. So for example, let's say I made another wave 1 move here, and now if this move dies here, I have to wait and watch. Sometimes we have when companies doesn't do much, we have to mark that point as move X, right? So it's like not contributing anywhere or doing anything. It's just a sideways move, a part of another correction, but not really starting a wave three. It's a period of silence, right? Or otherwise, if market still sees a value and this was just a institutional manipulation to bring it all the way down so that they can fill up their inventories on where they filled it up with before, we would want to see a move coming from up from here, right? So a break out should happen from here, and we should see a complete formation of first move here at least, right? So which we can mark it as 1 2 3 4 5, like we have it here. And post that, again, it's not going to just go away like that. It's going to retrace a little and then start the move up, right? So we'll have to keep validating that, hey, the company fundamentals, the revenues are improving. It's making the structure that we want before we start committing to it, right? And in other way, if you believe in the company, basically, hypothetically, you like the company, you have a faith in it. I mean, this provides a beautiful risk reward as an investor, that you're close to 78%, or you actually dip to 78%, where the whole move actually started after all this accumulation, right? This is where your demand zone is. Your risk to reward is pretty good. Your stop loss is going to be just right below this. If the stock drops from here, then it's something else and we'll have to re-look into it. But as long as it's holding, it's 78% retracement here, and you want to enter, you can enter. And on a breakout from 74, you'll get the confirmation of your bias that, hey, you were thinking it right. The company is going to outperform, since the accumulation is now complete from the market maker standpoint. They are just now going to mark up the prices, right? The market orders are going to come in, and there will be a FOMO which is going to be leading into the prices going up. right? So this kind of shows you a good example of an ending diagonal being used in the C leg, a leading diagonal being used in the one. So basically applying whatever we learned up here as in different formations, right? So ending diagonal happens in wave 5, could be in wave C as well. Leading diagonals happen in wave 1, could be in the wave A as well of the correction, right? So that was about zigzag wave and the impulse wave. So zigzag was a part of the correction. And now let's talk about another correction patterns, and we'll again apply the real time study as well. All right, and let's just go into that. So call this as zigzag. Uh, let's draw another one here. So we had this impulse move, right? And we got a correction here. The correction did not go like the one which I've shown before as a zigzag, but the B move retraces more than the 60% of the 50% that I shared before, but it goes all the way up till the top or maybe a little below that, right? And then we see a correction again coming back down, which either comes to this end point where it ended before or a little before that, right? So these wave structures, let me just mark these ones up. Uh, 5. Again, an ABC correction, but they are called the flats. There are like three categories in flats, and this is like a regular flat where your B goes up to the 90% of your whole A drop. It's not a dead cat bounce, it's a very strong bounce, and people may think it's a continuation gonna break out, but it doesn't. It stops at the supply, which is formed during the sell off, and when right? So during this sell-off, and goes test that, and the same sales cycle start again, and you get another leg down, right? So you heard that from me that in a zigzag you have a 5-3-5 pattern. The zigzag is different from flat in a way that flat is a 3-3-5 pattern, right? So the first leg is a three wave down and another three wave up, and the last leg is an impulsive leg where we have five waves down. Now, these five waves again can be an ending diagonal, like I explained before. The 4 and 1 can overlap in this C leg. It doesn't have to be. It generally is very impulsive, but it can be a overlapping wave as well. So this is called a regular flat and a 3-3-5 structure, right? So 3-3-5 regular flat. Again, you'll find all this information in the battle cards up there in the battle card channel, right? You can refer to the rules and everything else, and compare here and ask me any questions that you want to. This is your regular flat, and again showing you the application here in our PayPal chart. And I like this chart because it covers kind of all aspects that I'm talking about. Here you see an A dip with three waves. You had a B formation which went up to the top and a little above, and I'll talk about this. This is also a flat, but it's called the expanded flat, and a C dip which went below the level of the where the A ended, right? So a flat structure, an expanded flat, and why it is called expanded is just because that the move that happened here for the flat went little higher than the initial point, right? So that's a, that's a difference between a regular and extended, that the B can go higher than that. And why it kind of confuses everybody, because everybody thinks that the supply zone is broken, right? And everybody wants to go long, and they think that this wave was already completed as correction. Now it is the start of a new wave up, but instead they are pulled down and a large sell comes and all the positions get wiped out and you get stopped, right? So So very important to understand that, where you buy, and where do you put your stop, and should you be just buying at the breakout, or you want to let the breakout happen, a retest of the zone happen, because the supply needs to turn into a demand for the next move to happen. But if this was a false breakout and a liquidity sweep, then your supply is going to stay as supply, and you were just trapped into that liquidity grab that they were that they were trapping to, right? Or buy side liquidity trap it was. And it comes down all the way to the C. Now, this is what I showed you here before, right? An expanded flat. Why an expanded flat? Because this B actually went little above A. I mean, if it would have stayed here, it would have been just regular flat, right? Now, going back here, there is a third category for the flats. Again, all are 335, but in a third category, the B goes above, but the C does not come to the level of A or below. It just halts in between. It's again a 335, but it's called a running flat, right? Running flat, basically it's nothing. If you see the B wave went above this top of 5, and C is not even coming down. It's showing the buyers eagerness to get into the stock. They don't even want those lower demand levels to be tested. The stock is hot, everybody wants to get in. Any drop is like very small, and it just gets bought, right? So that's what the running flat is, and why it's hard to get a longs in here, because the B went in here, but still you got trapped, right? It happens quite often in the stocks which are again very desirable, right? So you won't see it very frequently, but something to keep in mind for sure, right? And how it can be looked wrong in a way is that since this was quite sharp and you had the C wave down, folks might think that this is 1 and 2, and now there is a 3 and 5, right? Whereas no, you will not have a 1, 2, 3, 4, 5. Uh, Sorry. Instead, you're just going to have a 5, right? So when this drop will start, it will just keep dropping. It's not going to end, because it's not 1, 2, 3, 4, 5. Let me just mark it so that you understand. But it was an ABC running flat, and you got this as your 5 wave move, right? So the drop is going to come larger than what you would expect and get trapped when you buy it here. That the sell happened, right? So you need to understand where the regular flat could have happened, and your entry and exit points and all that. So this was a third flat. So you learned about a regular flat where the retracement of B is 90% and C comes back down to A or below, or you have expanded flat where B goes above but C still comes down to A, and you have this running flat where B goes above and C doesn't even come near to A, right? So this is your third kind of flat. Now, the the question comes is, where does these frequently appears, right? And before we get into another types of correction, just wanted to help understand that the wave, which is zigzag correction, corrective wave zigzag correction, it generally appears in more than average times, you can say, in the wave two. Why? Because when the this rumor is strong, the stock is going up. The rumor just fades away and the stock starts to sell. It's a very aggressive sell, right? Makes sense, because if the stock or the company is already established, it's not just gonna get sold without any bad news or anything like that. But when the results are not there, it's still in infancy and all that, the sell is pretty fast, because people just want to get out before they know what the company is really going to do in the next coming year or so, right? So zigzag happens in two, whereas flats are more of an accumulation pattern that happens in the wave four. The the corrective waves flats, right? So they happen in four because so all the markup has happened in three. Now the big guys, they are waiting to see if company continues to deliver. They want to accumulate at little lower prices again. They just don't want to keep moving it up. So they sell it slowly in different waves here, right? Only retracing a portion of it, and then we get another last markup that they want to run through and empty their inventories that they accumulated in wave 4 as well, right? So flats would generally appear in wave 4. Like I said, zigzags will appear in wave 2. Now, what other kind of corrections do we see? The other corrections that do we see is the triangles. Basically, you had this five wave move up, and after the five wave move up, you get into something like this. Let's say a triangle, right? uh, yeah, I mean, it was not a five wave move up. It was basically a wave, interim wave. Just to correct myself there, this could be, let's see, let's just fix it so it's not confusing. Because triangles also generally appear in the wave 3. So just want to make sure it's marked as right. So sorry, triangles appear generally in wave 4, so I wanted to make sure it's marked right. And this is how it goes, right? So the way you will mark it is 1 2 3 4 5, and these will be called as A B C D E, right? So this corrective pattern has five legs in it, and each leg has three waves in it. So it goes just like this, right? So the pattern itself is called a 3 3 3 3 3. It's the triangle because each leg is three waves within it, and then the breakout is basically your wave 5, right? So this was a third type of correction: zigzag, flats, triangle, right? So again, can happen in wave 2 as well, but generally appears in wave 4. And just to show an example, then cost was a very good example where this happened, where between 2022 or yeah, 2023, there was a big triangle which was forming in wave 3, right? And the stock moved up basically after that. So A, B, C, D, E, move for the wave 5. So going back to our chart here. Now, the next thing that we should talk about is which is a combination of waves, which is your complex waves. Now, complex waves are nothing but a combination of these three waves which I shared before. It could be as simple as a zigzag first, followed by a move, and a zigzag again, right? While you have three waves here, you'll actually have three waves within this as well, here, and then you'll have three waves here too. They all are zigzag, but the way you put them together is a WXY. This is how the notations work here. It's a 3 3 3 structure. It's called a double zigzag because you had one zigzag and another zigzag. If you combine it with the third one, it can become even a triple combo as another complex where you had one another bounce and you have a third zigzag going on here, right? It's labeled differently here where we use a little different pattern here, WX Y, X, Z, just to say that it's a longer and a complex, more complex than a double combo, right? And it doesn't. It's this is just one example. I mean, you can have something like this as well, where your first drop is a zigzag, in between you got a triangle, and then another zigzag down, right? So they appear like that, and there are battle cards talking about double combo, triple combo, and all that. Familiarize yourself. But again, I mean, these are just a combination of the different families of correction that I showed you before. And when I said the family is like the zigzag, the flats, and the basically your triangle, right? So combination of those is what makes your combo, right? So now what I want you to do is, like I said, I created a lot of education material up there. There are a few things that you want to familiarize yourself. You now understand the retracement levels. You understand how far wave 4 can go, wave 2 can go, right? Where the wave 3 can go. What are the places where the reversals can come up? So basically, I shared a lot of candlestick patterns, right, which I want you to be focusing on. That okay, if the reversal is coming, what should I be looking for, right? If let's say I want to buy for this wave 5 move, and I understand, oh, okay, it retraced 38% in a wave 4. Now, what should I expect to see in the price action? In the price action, you want to see something like that, that buyers are stepping in, and you're getting a doji, or you're getting a hammer, or the previous sell candle was totally reversed by bullish engulfing, or you got a tweezer bottom, and all that kind of stuff, right? So this is where your candlesticks come into play, where you understand that, hey, this is my retracement level. I see buyers stepping in. Let me go and buy along, right? You want to buy at the demand and an expected retracement level. You don't want to buy at a supply level. You don't want to buy at a false breakout level, but always try to buy at a demand level on a pullback, right? And another important one, which I said is going to be useful to understand and use on frequent basis, is understanding these patterns as well. Now, these patterns are most important for a momentum trader, mostly a continuation pattern. Because what happens, I mean, when you are a buyer of short-term calls and all that, you don't want to buy within somewhere guessing where the wave 4 is going to end, and will be a combo or a zigzag or a triangle. You just want to find something which is already in a momentum, basically in a wave 3, and you see some balancing in that action, like it's moving fast, and it's stopping for refueling, or in the midway, like a wave 3 going up. uh, Let me just draw it for you again here. Let's say we are now in a wave 3, right? This is wave 3. So when a wave 3 happens, there are small pullbacks, right? They're in between some breaks, right? Because there are subcounts on a smaller interval, right? So before even the larger retracement comes as a wave 4 or something, all these wave patterns or combinations will come in handy, that where, okay, we are in wave 3. Oh, this is a pennant, right? Or a blue flag. Then, hey, this is a triangle here, right? We are in wave 3, so the triangle is supposed to be breaking out upwards. It's a very small time frame triangle as compared to the overall wave structure. It's going to continue up, right? Or a small whatever correction happened here, right? So you want to make sure that you understand these continuation pattern. And in the next few sessions, we'll be also talking about where the double bottom really happens. Where are these wedges? Like you see, this is your wedge, basically an ending diagonal, right? Or this is yeah, ending diagonal, right? Or on a price which is coming down, and this is an ending diagonal on a price which where it was going up, right? Or this was a continuation. Sorry, this was a wave 3, wave 4, and a wave 5, and a reversal has started, right? So we will be talking about all this in the next few sessions, but familiarize yourself with those battle cards, review this recording a couple of times, try to understand how to label the different waves, understand where we are in wave 3 and wave 5 and all that kind of stuff, and then we use these patterns to do the breakout study, and go long or go short wherever it's kind of appropriate, right? So this was all. Thank you very much. I know the first recording wasn't right where we had few questions, but I think I've covered most of the stuff. What I had covered, but again, we can do another session, and happy to cover if you had any questions. Thank you very much, and I'll upload this recording for your view. Thank you. Bye bye.